What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, we're breaking down two more level 3 advanced trading strategies here. The two strategies are the diagonals and also the calendars. So if you're excited for today's video, feel free as always to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. At the time of recording this video, we are almost at 1,000 subscribers. So thank you guys so much for your continued support. And again, feel free to spread the love of Fridge Financials, where you get free quality content because I love teaching people new things here. So what we're looking at for today's video is two strategies here. Robinhood has a long call calendar, long put calendar, short put calendar, and then Webull has it as calendar spreads and diagonal spreads, both level 3, which you do need margin for, and we'll make a video about what margin is and how it works, so be on the lookout for that. We're going to break down the ideas of how a calendar works and also how a diagonal works. So we're going to go right into it with an example. And what better stock to do than NVIDIA? And NVIDIA is having a rough morning. At the time of me recording this, market is open, and NVIDIA is having a rough morning, it seems like so far. So what we're going to be doing here is, again, you're looking at individual stocks. You could do this with SPY ETFs or QQQ ETFs and everything. But looking at NVIDIA here for today's example, what you're going to do is you're going to go over to trade options. And again, we've done videos where you have to be familiar with the options chain here. Again, buying versus selling, calls versus puts, expiration dates. You need to become familiar with the options chain first before we do anything else, because other than that, this will be a challenge. Now, let's say that you are somebody within a scenario here where you are going to be bullish on NVIDIA long-term. Saying, well, Fridge, I'm thinking that NVIDIA by the end of the year, December 19th, NVIDIA is going to go to, say, $160. So you're going to buy a call option because, again, the call option means you're basically hoping that NVIDIA goes up to 160. And as the price climbs higher and higher, you will see that you will be able to make some good money as a result. But the problem is saying, Fridge, I don't have $1,600 to pay for this strategy here. I'm bullish on NVIDIA, but I can't pay for it. And on the last video, we talked about spreads, how we did debit and credit spreads, where the idea was to make trading options cheaper, but it also limited your profit. This is kind of a similar idea here. And basically what we're saying is that I want to buy the option, but it's going to cost me $1,600. I don't have that money, Fridge. What do I do? So what you can do is you can say, I want to offset how much this is going to cost me. It's going to cost me $1,600. So what I'm going to do is I'm going to go up to a shorter date. Maybe I'm going to go 30 days out, 31 days here. And I'm going to sell a call option at the 160 strike. The exact same strike here, but I'm going to sell a shorter dated option at the same strike. Basically, it's selling a call option, which gives you down here. You're selling a call option, which pays you a premium up front here. And again, if you remember selling call options, it's a covered call essentially. And if it goes to 160, you would get rid of your shares. They're saying, well, Fridge, I don't have 100 shares. What do I do then? The good thing is that this bought call option is going to be your collateral. Because when you buy an option, it is equivalent to having ownership of 100 shares. So if you sell a call option at 160 and NVIDIA goes to 160 by the time this expires August 1st, this is going to be your collateral that you can exercise to then fill the order and you make your profit. As you will see, you make your maximum profit at that 160 strike. And what you'll notice is it does offset your price a little bit by about $400 cheaper, which is really good, obviously. It's still $1,200, but it's $400 less. And again, it does cap out your profit here of $585, but you still are able to get some really good profits as a result. Now, the good thing about this long call calendar spread, also known as a poor man's covered call, is that say by August 1st, we don't hit 160, you can still hold this bought option, then go to September and sell another one, then October, and just keep offsetting your price that you pay by collecting premiums. So if it goes to 159 and it doesn't expire in the money, this expires worthless. You can then push out one for September, October and do it again because this option still has time because it is for December. So that's a long call calendar spread, and you can keep selling options over and over and over again to hopefully offset your bought call option for a longer date. So for a long call calendar, you buy a longer dated call option, you sell a shorter dated call option, but they both have the same strike. I hope that makes sense. Now, what you could also do instead of doing the call side, you could do the put side as well. So I could buy a long dated one and say, I think the video is going to be actually at 150 by expiration. But again, Fridge, I don't have $1,500 here to make this happen. Well, let me think that, short term, maybe it won't move to 150 by the very end of August or by the end of July here. So I'm going to sell a shorter term option here and get this premium up front. So here's how much I'm paying for the bought option. Here's how much I get paid for the sold option. And the difference is $960. So I offset it by $500 and something. And again, if it goes to 150, I don't have the money to buy 150 shares or 100 shares at 150, Fridge. Well, this bought option does count as that collateral. So same kind of idea here. And again, 150 would be your maximum profit you would get here, but obviously it's very unlikely that's going to close at exactly 150. Maybe it's 151 or 143 or whatever, but you'll still make some good money as a result. So that's how calendars work. Now, instead of having it as a bought option, because this one is a total cost here up front. This one you're just paying for it. There's another way to do a calendar spread here, but it's called a short calendar spread. And if you look at Robinhood here, they talk about it right here. It's a short put. And basically, this is what it looks like. It's the inverted version of the bought long call or put calendar that you'll see here. So this right here is a bought option where you have this. The short one is you're going to basically just flip the options around. So what is that going to look like? Well, what that's going to look like is that you would buy the shorter term option, 150, and then you would sell the longer term. Same strike, different expiration dates, but now it creates the inverted calendar spread here. It's a short one instead. And what you'll notice here, instead of it being a total debit, it's a total credit. So you're paid $967 here. But the difference with this one here is that since you are being paid a credit, you need to have the cash available to buy 100 shares at 150 as a result. You need that. So what you'll notice is that if you do go in and try to open this option here, like I try to do right here, say I want to go for 970, for example, when I go to review order, it's going to say you can't do it because you need to actually have cash collateral. Because again, you're being paid premiums, you're selling options here. You need to have cash available to actually open this trade here. So you can do the sold option and to be the premium collector here with a short put calendar. But the difference is you need to have the cash for collateral available, which in this case, obviously I do not, so I cannot open this up. But again, this one is basically still betting on NVIDIA to have some sort of movement, but as long as it moves in either direction between now and the shorter date of August 1st, if it moves way down to 130, great. If it moves way up to 170, great. It's almost like a straddle or a strangle, but instead of paying for it, you're being paid for it, as you will see here. You're getting that credit up front. Now, that's how the calendars work. And again, they are advanced level strategies here. You need level 3 access. You need a margin trading account in order for this to happen because, again, of these selling options and the collateral you do need margin for these trades to work. The last option trading strategy here is what's called a diagonal. Now, how does a diagonal work? Well, let's say that you are going to be bullish on NVIDIA still. You're going to buy a call option for, say, January. We'll go a little bit farther out here. Say you want to buy the 160 strike for January 16th of next year. And you're like, okay, well, all right, Fridge, cool. Now, let's say that you're looking at the shorter term, though. Say you're looking at maybe October or something like that. You want to sell a call option here, but you don't want to do the exact same one here because this is what creates a calendar spread here. But say you want to sell it and say, I want to give myself a little bit of leadway in case the video goes past 160. Because if it goes past 160, this option becomes worth a lot. But then my sold option would lose value and the peak is at 160 exactly. Well, instead of offsetting this cost by, $1,100 and making it only be $500, I can go a little bit higher up. Say I want to go to 180 here. And what this creates is what's called a diagonal. It's a shorter term sold option here. But the difference in these strikes here gives your option strategy some more room to run. In this case, as you'll see, it gives you more room to run here as a result. It's going to cost you $1,228 up front here for a cost. But since you're selling this option here, your max loss is actually just going to basically be, as long as this expires worth this year, your max loss is about $700. Which is like, okay, it's not too bad. And again, it gives your contract room to run. So if it hits 160, that's not the end of the world. It's not the peak at 160 like in the calendar, because your sold option is at 180. That's where you keep getting more and more profit. On the bought option is going to increase in value. And as long as you don't hit 180, then you'll hit that maximum profit at 180. And then once you hit 180, it kind of loses a little bit of profit here as a result. This is called a diagonal strategy here. So almost similar to a calendar, but the real difference here is that you're not doing the same strike. You're doing two different strikes here as a result. And the shorter calendar, or the shorter option that you're selling, needs to have a higher strike. So you can do this for, say, August. If you want to go 45 days out, so you want to do a 170, it kind of looks a little bit weird. But say you want maybe like a 180 maybe or 185 or something like that. Again, you make a little bit, you'll get the $70 here as long as it hit 180. But if it climbs higher and higher, your bought option becomes worth more. And then once you hit that 185 strike price, you start to lose a little bit of value because this becomes in the money. But it's going to cost you, again, $16.75. So I wanted to open it. I would say, okay, let me do $16.79 here. It's going to cost me a lot of money, as you'll see. But it allows me, I don't need collateral or cash for shares or anything of that nature, which is really, really good. All right. And so that is basically the difference between a diagonal and a calendar spread. So difference again between the calendars and the diagonals. Calendars, you're buying the same strike price, just one is a sold option, one's a bought option. The diagonals have two different strikes here. So thank you guys so much for watching today's video. I know if you made this fun video, as always, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. I hope you're making money in the market in some way, shape, or form, whether it's through advanced trading options or just buying and holding for the long term. And as always, I will see you guys in the next video.